So the world's third biggest economy just ended their grand experiment of negative rates. The Bank of Japan has shifted policies, allowing the benchmark rate to hit up to 0.1%. Now, this is still a historic move. Japan has been under yield curve control for 17 long years. It should be bullish for the yen and the currency should be flying up, but that isn't the case. In fact, the yen weakened significantly against the dollar almost immediately. It went from 149 to over 150 versus the dollar. The market just doesn't believe the Bank of Japan. This rate hike isn't a sign that the Japanese economy is recovering. It's more of an admission that inflation in Japan is getting out of control. The BOJ wanted higher inflation and now they have it, but it isn't good news. We must understand why Japan has exited negative interest rates. Inflation in Japan is well above the 2% target, and this is a problem for an economy that's stagnating. Now, if Japan's GDP was growing fast and the supply of goods was rising, this wouldn't be a problem. China, for example, is producing too many goods relative to their demand, and that's why they had a spell of deflation. It's very different in Japan. They have both weak demand and weak production. The BOJ is trying to engineer demand through financial engineering, right? Through higher inflation. When rates are negative with the yen crashing hard, it should increase spending. And that is the hope, that's what Kishida is praying for. In February, Japan's manufacturing activity fell to the lowest since August 2020. The PMI data showed a stagnating economy. Industries are contracting because demand simply isn't there. The whole idea of yield curve control was to force consumers to buy more stuff instead of saving money. Why save money when it's getting weaker every single month? And in theory, this should grow Japan's local demand. But the converse happened. People were still saving money. It was supply side inflation from the wars that happened. The conflict in Ukraine caused energy prices to spike higher. But it wasn't just the BOJ that pushed for higher inflation. The Japanese government themselves wanted wages to go up. Kishida was hammering on the unions to jack pay up, and his wish was finally granted. Japan's largest union group secured a whopping 5.28% wage increase for workers. This might sound like a nothing burger, especially if you're in the West, in the US, but in Japan, this is a very tremendous pay raise. This is the biggest pay hike in more than 30 years. The average increment was around 2% at best for over 3 decades. A sudden rise above 5% means only one thing: consumers have more money to spend. Japan raising rates today is not a sign that the economy is strong. It is a move to front run the inflation genie, the inflation problem, and hope that higher prices today can build further demand. But there's a problem here. Japan might not be able to force interest rates above zero, but trying to go much higher is unthinkable for the economy. There's too much debt in the system, and the entire country is too dependent on lower rates to function. The market is telling Japan that we don't believe you. What you just did is essentially meaningless. And on this channel, we said before that Japan would eventually hike rates, and they did. Not because they want to, but because they would lose to inflation. However, we also mentioned there's a limit to these rate hikes. Japan can't follow the Federal Reserve and hike to 5%. It will collapse both the global markets and Japan's economy itself. And it's important we understand why. It's the two doomsday scenarios we keep hearing about, and there's some truth to them. The first is the Japanese yen carry trade. Because the yen was the only negative yielding currency in the market, it kind of makes sense to borrow it. It is extremely cheap compared to other currencies like the euro, the dollar, or the Swiss franc. Many investors in the world would borrow Japanese yen, sell it for other currencies, and buy foreign assets with it. For example, I would borrow a million yen at negative or near zero rates. I then sell it off for US dollars and buy dollar assets. It can be US treasuries that yield 4 or 5%. Now, as long as Japan keeps rates negative, two things should happen. I would lock in a 5% yield for my US treasury bond. At the same time, the yen would continue to collapse. And over the past 12 months, the yen has fallen by 12% to the dollar. That's a gain for me as well, because it costs 12% less to use dollars to buy back the Japanese yen. I can repay my loan at a cheaper rate, the yen is devalued. My total return will be 12% from the exchange rate and a 5% gain from the bond yield. That's a 17% return. That's how much money traders were making in this yen carry trade. It's extremely lucrative, and it got so crazy that investors were borrowing in yen and buying Mexican bonds. The yields on these peso bonds were above 11%. It works so well that you will make more on this trade than investing in the S&P. And that's how insane things were. But if Japan were to hike rates up enough, This would unwind the entire carry trade. The yen would strengthen and your return on the bond yields could get wiped out. You might even suffer a big loss here. And that is the doomsday scenario number one. The next end of the world story is also tied to the yen strengthening, and it's the investment money flowing back into Japan. There are around $4 trillion worth of Japanese assets abroad parked offshore. Almost 670 trillion yen are invested in foreign assets. That is a lot of money outside of Japan. Because rates are just so low, investors are buying up foreign assets, including stocks and bonds. At least 71 trillion yen is parked in US bonds alone. That's an enormous amount of money that can move the markets. And here's the big worry. If the BOJ hikes rates further, this might cause investors in Japan to dump their foreign assets because the yen would strengthen and they could get a higher yield back home. They would flood back into Japanese government bonds, the JGBs. So in theory, US treasuries could crash and the US economy would be affected. Now that sounds like a very nice doomsday story and it sounds very plausible. However, it likely won't happen. It only works if Japan can hike rates much higher, which they simply can't. Now, there's a reason why 60% of respondents don't believe this will happen, and I'm part of this 60% as well, because Japan is trapped. And let's understand why. The BOJ is hiking rates not because the Japanese economy is strong, it's because inflation, once again, is getting out of control. Firstly, the Japanese government is in extreme debt. It's worse than the US or China's debt crisis. It's going to reach almost 270% of GDP by the end of 2024, which is a big problem. Now, the Bank of Japan holds over 53% of the government debt, slightly above half, and you could say it's a non event. But what about the remaining 47%? That is a disaster that must be addressed. Because of this debt burden, Japan is spiraling into a fiscal crisis. A lot of money is being spent to service these bonds. Japan is projected to spend 28 trillion yen in 2024 to service the debt. That's around 22 to 25% of their annual budget, which is insane. It's more than public works, defense, and education combined. And that's when bond yields are near zero. So just imagine if rates keep going up, and higher. Japan's economy will be in jeopardy. Investors will look at this and realize that it's a house of cards. There's no way on earth to pay back the debt without printing money. And if you have money to invest, would you really throw it into Japan? Of all the G7 countries today, Japan has the second lowest credit rating. It's worse than the UK and just one level above Italy. And this is something everyone knows. If the Bank of Japan stops buying bonds completely and left things to the free market, yields will fly up to the moon. It could go above 3, 4, even 5%. The only thing keeping the economy afloat is the BOJ. They are on borrowed time. Even though Japan ended negative interest rates, they are still in the markets. The BOJ is still buying JGBs worth around the same amount as before, 6 trillion yen per month. In other words, they are still suppressing interest rates because they can't allow borrowing costs to fly up. Japan's debt crisis is just too big. There's very little room left to maneuver now. It's easy to think that the BOJ can keep buying forever. They have over $70 billion in paper losses, and it'll get even worse as interest rates increase. But it's not that simple. The entire financial system is built on trust. The losses on the balance sheet might not affect the real economy, but it does affect investor confidence. Japan has a shrinking population and exports are going down. If you throw in a central bank that's losing a ton of money, it's not a good look. It undermines confidence in Japan's economy. According to Fitch, if they keep hiking rates, the BOJ's paper losses will be unthinkable. It will reach nearly 12% of Japan's entire GDP. It will be impossible for the government to bail them out. If Japan hikes aggressively, the confidence game might end, the national debt burden will explode, and the bond losses will be horrific. And all this points to the Japanese yen weakening even further over time. And that's why the yen is still falling. The market is realizing that Japan, they are essentially trapped. And that's just the debt burden and the BOJ. We must talk about the economic front. Raising interest rates to defend the yen sounds really nice, but what about the actual economy itself? It's a big danger to companies and Japanese exports. Let's talk about the export situation first. In December and January, Japan's exports saw an impressive rebound, increased by 10% each month. A big part of it was the holiday season and the Lunar New Year. So Japan sold more stuff to both the US and China. Japan's economy still relies heavily on foreign demand to grow. It's not like the domestic markets of the US and China. The US is the world's biggest consumer market, we know that, while China is shifting towards more domestic consumption. So they are more self-sustaining than Japan. A big reason for the export rise is a weaker yen. Margins in Japan are rising because of the weaker yen. Japanese companies abroad can repatriate their profits and earn more. It's 10 or 20% higher when converted from dollars back to the yen. And it's a big reason why companies are enjoying record earnings even though domestic demand is weak. A weaker yen is helping their bottom line. As an exporter, a weaker currency helps you grab even more market share. But if the BOJ hikes rates aggressively, this could crash Japanese exports. We are in a global slowdown and prices matter a lot. They will lose ground to their biggest competitor in manufacturing, which is China. Over the last 20 years, the yen has been collapsing against the Chinese yuan. That means it is cheaper to buy Japanese imports versus China based on the currency alone. It's a big reason why China buys a lot from Japan as well. The strong yuan allows China to buy more. But if Japan hikes rates and strengthens their currency, it would affect exports to the world. China will benefit the most because its biggest competitor is scoring an own goal. So on this front, Japan can't hike further without affecting exports. However, there's another problem here. Because rates were so low, companies in Japan were selling tons of corporate bonds. It was cheap to do so. Since 2014, bond sales in Japan has been rising year after year. Borrowing costs were dirt cheap, so companies issued a ton of debt. This hit almost 17 trillion yen in 2023 alone. The BOJ can't hike rates much further without pushing Japanese companies off a cliff. If the benchmark rate hits 1%, borrowing costs could double or even triple, and this puts a lead on any future rate hikes. The issue here is the complete wipeout of zombie companies in Japan. Low margin businesses could go under, and there are over a quarter million zombie companies. Around 17% of all firms in Japan are zombie corporations, and these companies could go under. That will result in higher unemployment. This will tank the domestic economy for quite some time. The Japanese economy is incredibly leveraged here, so there are serious risks with hiking rates further. Mortgages will go up, renters will be in trouble, and consumer loans will balloon as well. It's important to put Japan's rate hike into context. Leaving negative rates behind is a good idea, but it doesn't mean Japan can go higher without any big risks. Rising rates in Japan creates more domestic losers in the country than winners. We have borrowing costs for the government going up. The Bank of Japan and regional banks will be suffering big bond losses as well. Exporters will also suffer, while zombie companies could collapse. There are just too many time bombs in the system that could literally blow up. And this is what happens when you try to financially engineer economic growth. This doesn't solve the systemic population problem and shrinking domestic demand. The only way out for Japan is for the Federal Reserve to drop interest rates and for global demand to pick back up. But that will be just a short-term fix. Japan's debt crisis and population problem is only going to get worse over time. But let me know what you think. How far can Japan hike rates? And could this push the economy off a cliff? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.